The 2022 stock market collapse is restarting, and this time it is going to be really bad, according to YouTube. Because you see, after 2 months of the stock market going up since the 16th of June, we have the worst thing that has ever happened in the history of investing. A few red days, including today. And the moment a few red days happen, it is of course immediately obvious to everybody that this is the end of the bear market rally. You must absolutely sell everything right now before everything crashes to zero. China's economy will collapse in exactly 25 days. Michael Burry has absolutely perfectly predicted all 69 of the last 3 stock market crashes. The world order is changing and everything, I repeat, everything is about to collapse. The oil price is crashing, commodity prices are crashing, China is crashing, the stock market is crashing because, you know, it went down for a few days. YouTubers are once again constipated, sitting in front of an increasingly ferocious fire. Chickens have re-emerged from their sulk to remind you that of course they were right all along, and you better believe it. This is 100%, definitely, absolutely, categorically the worst crash the world has ever seen, because look, data. Previous crashes had long-term rallies during the crash, and we've just had a rally in the last 2 months. This confirms everything, and it of course categorically confirms that the worst ever stock market crash is coming. And technical analysis does not lie. Look, it clearly spells out crash on the year-to-date chart if you look carefully. As a retail investor being presented with this mountain of irrefutable evidence, I imagine it is very easy to conclude that the world as we know it is over and you might as well capitulate. Now, here is the thing. The stock market might crash hard in the next few months. It is possible. Inflation is at 8.5% in the US and just went above 10% in the UK. The housing market, business investment, consumer spending, and factory production are all in decline in 2022 after booming in 2021. So it's very easy to spin the narrative that we are in a recession, demand is being destroyed, and the stock market is going to feel the full force of this slowdown over the next quarter or two, with a giant panic sell-off heading into the winter. But there is another side to this coin. The job market is remaining strong despite inflation, with US employers adding 528,000 jobs in July after already adding 372,000 jobs back in June. Commentators will argue whether we are or we are not technically in a recession because, you know, GDP has fallen for 2 consecutive quarters, but businesses are aggressively looking for growth through a massive hiring spree instead of batting down their hatches and going into defense mode. Household debt has jumped to a record $16.15 billion in Q2, which is up a massive 10% since Q1 2021. And this increase looks really bad, far more dramatic than back in 2008. But then you go and remember that we now have almost 10% inflation, which means that inflation-adjusted household debt is actually barely moving. It's a kind of interesting concept, right, when you apply a bit of critical thought. Credit card and loan delinquency rates are spiking in 2022. That sounds very concerning. Credit cards are typically the first indicator of a major financial collapse because people stop paying their credit cards before they stop paying for their car loans, their phone contracts, their rent, their mortgages. But the delinquency data is still lower than at any point before 2020. So there is that. And the balances outstanding are considerably lower risk than they have ever been before. Drawing parallels with the performance of the stock market back in the 1970s is very popular, given that is the last time we had major inflation, and can be very interesting from a curiosity point of view. But there are fundamental differences between now and the 1970s which actually do mean that yes, this time is different. 50 years is a long time. No 2 particular economic cycles are alike. The US economy has morphed from mostly US-centric companies dominating the stock market to global companies that run much of the global economy that all happen to be based in the United States. The stock market itself has matured significantly with technology, trading, and information availability, making the market considerably more forward-looking than it has been before. The concept of future economic factors being priced in may be an imperfect one, but it certainly applies far more today in an age where information is abundant and readily available. And I know that some people out there will go straight to the comment section and say, "Hey Sasha, you're so dumb. China's economy is about to collapse. Sell everything, buy gold bars, and stick them under the mattress in your doomsday bunker." Now, there are 4 really important reasons why I ignore all of this noise and just keep on investing first. I know a lot of people out there will tell you that to be a great investor, you have to time the market cycles, because if you don't, you're an idiot, apparently. A lot of these imbeciles in the comments section will tell you that they perfectly timed it by selling everything at the end of December, and I am sure that a few months after the market fully rebounds from wherever the bottom is, they will confirm to you that they also perfectly timed the bottom as well. The unfortunate truth is that the people who tell you this are full of shit, because if they weren't, they would be billionaires after just a few years of doing this and perfectly catching every swing up and down. It can be fun trying to guess a coin flip. You might get it right once and double your money. You might get it right twice and quadruple your money. But as many gamblers find out on a long weekend in Las Vegas, eventually your luck will run out and you will lose everything on that one coin flip that goes against you. You might think that you know exactly what's going to happen. A lot of new investors fall into that trap, but the simple fact is you don't. I don't, nobody else does. The second reason is that even if the entire economy of China was to collapse hard, which a lot of people are talking about because, you know, it gets huge views on YouTube, it does not necessarily follow that the US economy and every other economy around the world would collapse hard too. They could, but there is not a necessary causal relationship. China's property market is relatively insular relative to the rest of the world, and that's what everyone's talking about. China's banks are perhaps even more insular. A lot of US companies manufacture their goods in China, sure, so there is going to be a lot of disruption potentially, but if there is a major financial crisis in China, does that mean that the production will stop? Does that mean that the workers will physically stop going to that factory to manufacture the goods to earn money, you know, when money is tight? Financial crashes can be regional, and they often are regional. And if the drivers of the crash are also regional with relatively little capacity for overspill, it can mean, and it sometimes does mean, that the crisis can be contained to the region. Even if it's a major economy like China, back in 1998, there was a huge financial crisis that absolutely destroyed the economies of countries including Indonesia, Malaysia, South Korea, Russia, Brazil, and many others. These countries had complete meltdowns. Currencies got devalued by orders of magnitude. I remember it well because I lived in Russia at the time, but most people in the US probably didn't even notice that it happened. Here is what happened to the S&P 500. It had a 2-month correction as it went down about 10%, but it was barely a blip, and it went right back up. Now, the third reason why I continue investing is that in the long run, great companies don't care too much about macroeconomic factors. Sure, there will be temporary impacts. Sometimes the share price will move up and down, completely independent of what the company is doing. It's possible, but I don't measure company performance on the share price. This is really important because a lot of people seem to confuse company performance with the share price movement. And when I see a company growing, investing more in its growth, becoming a dominant player in a growing industry, doing exceptionally well, improving their balance sheet that is already phenomenal, when I see data that strongly infers that the growth of that company will sustain into the future based on the best information I have, I don't really care what a few months later this year might do to the share price. I care whether that company is going to do well in 5 or 10 or 20 years' time. As an active investor, my aim is to pick companies that will outperform the market. If I wasn't doing that, I might as well just stick everything into the S&P 500, which is probably the better choice for almost everyone out there. And I know that you can't pick the Apples and Amazons every time, I am fully aware, but here is the absolutely devastating impact of the dot-com crash on Amazon, and then the massive drop in the share price from the financial crash. You can see how massively noticeable they are on this chart, and if you were an investor in Amazon, you probably suffered a lot, and you're probably right now sitting and wondering why it was that you bought Amazon before those crashes. And here is these same two crashes on the Apple chart. Again, I know that anyone investing in Apple at $1.60 at today's prices just before the financial crisis absolutely livid at the outcome 15 years down the line. And here is another really important reason. We are already in the middle of the crash. Everybody shouting from the rooftops about the impending collapse seems to kind of conveniently miss out on the fact that the stock market is already 12% down so far this year, and a few weeks ago it was down more than 20%. Can the market crash even further from here? Sure, I have absolutely no idea. But I also know that historically, investing at 10 to 20% below the previous high is an extremely fruitful time to be investing. Far, far better than average. Now, it could get even better, but I'm the kind of guy who doesn't look a gifted horse in the mouth. Call me simple. Many of the earlier stage companies, growth stocks and such like, are down considerably more. Many of them are currently down 60 to 80% in their share price. Now, a lot of them will not recover from here because a lot of them actually have unsustainable business models. A lot of them might suffer as a result of an economic slowdown. A lot of them perhaps were massively overvalued before. Some of them will die a slow and painful death. But this is a space that I personally invest in. And there will be some companies out there from this pool that will recover and then some. And those companies have already sold off massively along with every other growth stock since November last year. I am already shopping in the discount aisle with 80% off stickers on some of my favorite chocolate bars. Sure, I could wait and see if the stock will fall another 10% from here, and then the discount rate will be 82%. Instead of 80. But if you feel that there is a huge upside, and your thesis turns out to be right, should you go and collect that upside today and not risk missing out on the train after it departs? Or do you want to be greedy and try to squeeze every last drop from the lemon? Well, the answer is up to you.